Yes, so I will be talking about the regional economic outlook, developments, and some policy challenges going forward. Region, I mean Central, East, and Southeastern Europe. So this is a broad brush of countries, and I'll present some cross-country comparisons. The idea is to see the region as a whole and how some countries differ within that. So I will not be discussing particular cases of countries, and I will not be talking about Belarus in that context, but rather the set of countries, however, there are many 10, 12, 15 that we have in the sample. The other caveat is that this is a crisis that's not very old, and it's still moving. And moving in ways that are unpredictable, like the news a few hours ago that the Russians were gonna cut off gas for Poland and Bulgaria. So that has impacts on many of the things that I am presenting. So that obviously will change, but I will try. So what I'm trying to do here is talk more about sort of the more conceptual ideas that we might want to use to think about how the Ukraine war crisis will impact these regional countries. So with that background, let me start with a bigger background, which is what I usually start such presentations with, which is the idea that basically where are these countries today relative to where they were 20 plus years ago. This is important to realize this context because many of these countries have done really well in the past 22 years. And for completeness, let me just mention these countries. So we have Poland, Hungary, Romania, Bulgaria, and Croatia, Czech Republic. And then we have the states of Southeast Europe, the Western Balkans, Serbia, Macedonia, Bosnia, Albania. And then we have a couple of Eastern European countries, which is Ukraine, it's Kosovo. And then we have, just for comparison purposes, I put in some charts for Belarus. So what you have on the left-hand side is a GDP per capita adjusted for purchasing power parity. And it's shown as a percent of German levels. So German GDP per capita in purchasing power parity terms. So what you can do here with the left chart is to say where the country was in terms of its income per capita, adjusted for price differentials, relative to Germany. And what you can see is a remarkable progress in the top set of countries. These are the fast convergers of Central Europe, as we call them. Poland, Hungary being the main ones, Czech, also Croatia, rising very rapidly. For example, Poland rising from around 40% of German income levels to more than 60 in 20 years. So that's a remarkable convergence. We have some countries that have not risen that rapidly, but still risen, and these are in the bottom set. But then we also have a few that have either leveled off or are actually declining. So on the leveler offs, we have Albania, Serbia, and then in the decliners, we have Belarus. On the right-hand side, we have the same kind of data showing how income convergence, the concept of income convergence, which is that the poorer you are at the starting point, the faster you will grow to catch up. So income convergence is a catch-up story. And this chart shows that, which is that GDP per capita of these countries in 2000, same data that we have on the left, is on the x-axis. On the y-axis, we have how this real GDP per capita has grown over the last 20 plus years. And basically, if you were poor in 2000, which is x-axis closer to 0, you would have higher growth. So y-axis higher. And that's what you get, a downward sloping line. And you see our countries are clustered around this. Some are doing better than average, which is above the line, and some are doing worse than average. But generally, the convergence story holds. So with this background, what I want to do is talk about how these economies were in a better place before the global financial crisis, compared to where they were before the global financial crisis. So I'm having some trouble here. Just give me 1 second. Do we know how we can move the top panel away so that I can read the slides myself?
Well, try, maybe moving the Zoom window, but otherwise.
Okay, let me try and so what we have here, the point I'm trying to make is that before the pandemic broke, what I want to do is start with how things were during the pandemic or just before, and then come to the war. And I think that's important because these economies have been in a very different place before the start of the pandemic than they were before the start of the global financial crisis. Global financial crisis, as you know, had strong effects on these countries in the region, primarily through the external side. And they had wide current account deficits, as you can see in the blue bars for 2008. And as you can see, that weakness was not there before the start of the pandemic in 2019. So these countries were in a better place, with some exceptions. I would say Montenegro, Albania, Serbia, perhaps more than others, but some of them even had current account surpluses before the start of the pandemic. This put them in a good place at the start. And the COVID-19 shock allowed these countries to respond with good policy action. On the left-hand side, you see the monetary policy action, the reduction in the policy interest rates by their central banks for the countries that have their own currency. And you can see a very substantial decline in policy rates. So there was space there for policy to fight the pandemic and basically provide stimulus to the economy. On the right-hand side, we see the fiscal response that was also very strong. I compare here the fiscal balance, which is adjusted for the economic cycle in 2019 and 2020, and you can see from 19 to 20, there's a very substantial loosening of the fiscal balance, so more deficit to support the economy, which of course, as you know, was being shut down because of the pandemic. The private sector was shut down, so the government sector was stepping in. So this is very much consistent with the story that you would want to see in these countries, which is that public sector moves in when the pandemic hits, and that is pretty consistent in these economies. But we do see, I think one area that is important here in terms of the pandemic is to think about scarring, like how much long-term impact did the pandemic have on these economies. And what we have here is a GDP level projections that we have done ourselves. So the red line on the left shows what we were projecting for these economies, their GDP level, just before the pandemic started in January of 2020. Our World Economic Outlook was projecting these kind of growth rates with these kind of GDP levels. And then today, or a few months ago, what did we project? And what you can see is a very clear sort of drop in 2020 in the level of GDP, and then it catches up. And the thing is that the catch up is very strong, and it is eventually going to meet up with the red line somewhere around 2026. But the catch up is also varied by countries. The Central European countries have very strong catch up, and others have weaker. What I have on the right-hand side is the revision to the GDP projection, similar concept that I was just talking about. And you can see that between 2019 and 2022, these revisions have been substantial. Let me move on to the war and where things stood just before the war. So as was also mentioned in the earlier presentation, we had fairly strong inflationary pressures coming in. What I show on the left-hand side is the contributions to inflation in 2021, last year. Where was it coming from? So on the left bar, we have the Euro area countries, and on the right side, we have our Central, Eastern, Southeastern European emerging economies. And you can see the black dot, which is headline inflation for that year. The headline inflation was very strong in emerging Europe, much stronger than in Euro area, and it was coming from, as we know, a strong energy price surge. This is also shown in the previous presentation. This is the orange bars. It was contributing a lot more to the inflation in emerging Europe. But what is interesting is the blue portion of the right bar, which is the underlying pressures that the economy-wide pressures that were coming in, and those were also quite strong. So inflation had been there. It had become it had transitioned from being more of a supply shock kind of story to broader based demand factors. Core inflation, which is again our concept of underlying factors of inflation, taking out the various items that move with high frequency like food and energy. So the core inflation on the right-hand side was showing for these countries a very strong trend upwards to January of 22. And you can see that a very, very strong rise going there. Central banks, of course, had started reacting to that and had started tightening against those pressures as there was increasing realization that these are demand pressures. So you will remember, if there are supply shocks, then monetary policy and interest rate changes cannot do much, but they can impact demand pressures in curbing demand when there are demand pressures are rising. By raising interest rates, you can curb demand pressures. And that is what the central banks started doing more and more around the second half of last year, and those trends you can see here. The fiscal position, how it changed basically before in 2019 to over the next 2 years, we can see that fiscal, what we have on the left are the debt levels in relation to GDP, a fairly broad range from Bulgaria, which is 25, to Montenegro, which is exceeding 90 now. But the red part of the bars indicate how much that debt went up as a result of the fight against the pandemic, which I mentioned earlier, the fiscal response. But there was a sense, there is a sense that between 2020 and 2021, the fiscal deficit did begin to tighten, and that there was an attempt being made to bring the debt levels down by having a stronger fiscal adjustment. And what you see on the right-hand side is the red dots, which are showing the cyclically adjusted primary deficit, which, as you can see, is lower than the blue bars, which were operating in 2020. So there was some pullback, but somewhat partial in some countries. Labor markets were going strong, and that is indicated on the left-hand side for the 3 years, 19, 20, 21. We were beginning to see a sustained drop in the unemployment rate. And on the right-hand side, we have the output gap, which, for those who don't know, is basically where the actual position of the economy is relative to its potential. So negative output gap means the economy is lagging its potential. And that was the case certainly in 2020, because as I just mentioned, the economy was shut down because of lockdowns, but that output gap had shrunk quite a bit in 2021 and had pretty much vanished in many countries, and was beginning to show positive, which is that the economy was beginning to operate beyond its potential, or what you may call overheating. The war in Russia, the war in Ukraine, the consequences have been talked about a lot. So I'll go through this very quickly. But from the standpoint of economics, basically, What you should expect to see, and what we are seeing, is a surge in risk aversion, has been creating financial turbulence, movement of money around in the region. There is, the issue of the inflow of refugees, which is very large numbers in a very short time, has challenged, of course, the capacity of governments to deal with them, but also the fact that it will have fiscal costs in terms of supporting them. The sanctions on Russia, which I believe we will hear more details about later, our sense is that they have muted global impacts because Russia was not so integrated into global markets except for energy and some food that we saw earlier. But countries that have had closer economic links, of course, those on the periphery of Russia, southern countries to the south of Russia and some to the east, but not all, are at risk. And I'll talk a bit in a second about that. And lastly, I would say that as we also heard before, the price shocks have created severe impacts for households, also for firms, but households particularly, because the rising inflation had already been a challenge in terms of drops in real incomes, and now you have a even more increase in food prices and energy prices. So this is a challenge going forward, and this also, in a way, the price shock, as I was saying earlier, complicates monetary policy because a large part of it is coming from supply, but also lingering demand pressures. So it confuses, in a way, the way monetary policy should work, and I'll come to that in a second. The geopolitical risk index, what I was talking earlier about the increase in risk aversion, we have it here, as you can see on the right-hand side of this chart. In February 2022, it just spiked to almost 1,000 when it was in the range of 200s before, and this is really the reality of how this war has transmitted to some of the perceptions about risk in the financial markets and others. We have seen, investor confidence has suffered, and we have seen financial turbulence. What I have on the left-hand side are financial flows, ETFs and mutual funds in Central Eastern Europe for both equity markets, stocks, stock exchange companies, and as well as debt instruments, bonds. And what you can see here is that the bond market has been severely affected as a result of the. It had been showing a decline before, but it has sharply driven down as a result of the war. Exchange rate pressures have also hit these currencies as a result of the starting of the war, and that you see on the right-hand side. The red dotted vertical line separates when the war started, and you can see a spike in some of the currencies, of course, most prominently for Russia, and but also for other EMs in our group. The refugee flows that I mentioned earlier. So what you have here on the left-hand side is a context of how large these refugees out of Ukraine compare with what we've seen in the past. So we have two spikes in the past: the Yugoslav wars in 93 or early 90s, and then you have the civil war in Syria and the refugee outflow from that, which is around the 2015 mark. And you can see how these numbers are substantially higher in a much shorter period of time. The distribution of refugees, where they're going, initial destination, we don't know final destination because of the lag in reporting, but initial destination, more than half are in Poland, are coming to Poland, but also Romania and Hungary. One story that doesn't get picked up so much, and it's more recent data, is what is happening to these refugee flows over the last few days. And as you can see here, what we show here is the flows across the Poland-Ukraine border, which is the border that has seen the most movement of refugees. And what the blue line shows is the incoming refugees, and the red dotted line shows the outgoing movement from Poland to Ukraine. And what we are beginning to see since middle of April is that the flows are beginning to cancel off. And so in terms of accumulation, which is the bars, are showing that in fact, the net flow may be close to zero, or it may in fact be negative for some periods. So the big surge, so far at least, has happened. And that happened in March, early mid, through the most month of March. And then now we are seeing trickling net flows around, at least around the Poland border. So I think one thing to think about is, the first question that comes to mind is, how are these countries exposed to the Poland-Ukraine crisis? And what I showed here on the left-hand side is the goods and services exports that these countries have to Russia and Ukraine as a share of their GDP. And what you can see is that these numbers are not high for most of these countries. The three countries that stand out are the Baltic states, the smaller Baltics. They're smaller countries, and they have been more connected to Russia. So that shows up in the numbers. But when you look at the total exposure to Russia, which is as a percentage of value added, not gross exports, these numbers drop even further. So you're looking at a range of 2% to even 0.5%. So the trade exposure of these countries is not that strong to export exposure to Russia and Ukraine. And this is the backdrop of the first charts that I showed at the beginning of convergence, which is that convergence that happened in these countries of fast growth in the last 22 years was in fact a reorientation of their trade channels towards the EU and away from the Eastern markets. And one thing you see on the left-hand side chart here is how exports to Russia have gone in the last, what is interesting is in the last, I would say 8 years, which is that 2014 seems to be a turning point in how exports to Russia have been dropping for these countries as a share of their GDP. You know, that's also shown in the right-hand side for the 3 years that we measure, 2000, 2014, and 2021. One interesting aspect of how the shock will transmit to these countries, of course, is perhaps the most important aspect is the energy shock. But the way the energy shock transmits to your country depends on how exposed you are to the various elements of energy which are in shock, which is, as we heard earlier, one was natural gas. So what we do here is we break down the total energy supply in each country by the product, which is what is it oil and oil products, natural gas, coal, renewables, nuclear, and other. And what I show at the bottom level, the bottom numbers are showing the share of domestically produced energy products. So if you produce more domestically, of course, you're less exposed. So this chart kind of gives you a broad sense of where the high exposures would be of these countries. One thing to think about is countries like Poland, for example, have been very reliant on coal as a result of their earlier strategy of energy security, moving away from gas. And that, in fact, shows here as something that will actually allow them to buffer the shocks in the energy prices because of the coal that they have. Here we show another chart which shows the energy dependence on Russia, percentage of energy commodity imports. And you can see here the numbers seem large for places like Poland, but in fact, Poland does not import a large amount of energy. And what it does import, it is heavily reliant on Russia, but that can be moved away because in the bigger picture in the economy, it's a small share because imports of energy don't account for a large share of Polish imports of Polish energy. Intermediate inputs from Russia, I mean, that's on the right-hand side. When you look at those also show numbers that are not significantly high. The broad policy conclusion from these shocks and the war in Ukraine is that monetary policy will likely remain constrained by inflation, which means that you can't use monetary policy to fight the shock because inflation is a concern. And so fiscal space, countries that have fiscal space would be the ones that would be able to mitigate the effect of the crisis through fiscal policies. I mentioned them earlier, accommodating refugee flows and making sure there are support systems for refugees and protecting households and industries vulnerable to high food prices and high energy prices, at least in the near term. How do we see risks to the macroeconomic outlook going forward? So, there are some upside risks, which means positive silver lining. If there's a quick de-escalation of the Russia-Ukraine war and faster pandemic exit, then the growth projections that we have for these countries could be better. But downside risks are more likely to dominate: the lingering war, the interruption in gas flow in Europe. This is news from a few hours ago, and it could get worse. Persistence of global supply chain bottlenecks. This is the story from last year and before, when we were beginning to see the effects, when we saw the effects of the pandemic causing supply chain disruptions, and that was triggering shortages of important inputs like chips for various machinery, and was resulting in curtailing of supply and also raising prices of these commodities. Whether we'll have another outbreak of COVID and how severe that will be, we don't know, but that's a risk going forward. And the other thing is policy tightening and how that compares with the economic recovery that we have. Balancing that is a challenge. Let me stop here and take questions. Stop share.
Thank you, Nadim. And we already have questions, so let me read a question from Vadim Yusuf. So in the latest World Economic Outlook, it is projected that the GDP of Russia and Belarus would fall quite substantially this year. But in 2023, Russia is projected to continue contracting, while Belarus is expected to recover slightly. Could you comment on what could be the reason for the recovery of the Belarusian economy next year?
I think that recovery is slight. Belarus does depend on Russia, but I think the immediate impact of it should be seen in the context of GDP levels with sharp drops in growth rate, drop a lot, and then small recoveries mean still the GDP levels are low. I think what's happening in Russia is the consequence of the sanctions, and we feel that those numbers are very likely to be large. The drop, as you would expect. I'm looking at the numbers here. Russian economy. We have. Let me see. So we have 2022. We will be seeing something like from
-6, I think, right?
Yeah, exactly. It's minus 8.5% from 2.8% earlier projection that we had. So these are very large numbers for Russia. For Belarus, we expect a decline, but there's a leveling off of that next year.
Thank you. So the next question from YouTube. What should be the monetary policy in the country which is facing both the supply side shock and also the global inflation shock?
So yes, so this is actually the question can be nuanced even more. Whether you're facing the supply side shock from the pandemic, you are then facing a commodities shock coming out of the war, and then there had been underlying demand pressures that are still there. For example, I'll give an example of Poland, where the economy is doing quite well. And there is a sense that there are generalized demand pressures in the economy. So how does a central bank deal with that? And that's a very tricky question. And this is what I was alluding to earlier, that central banks have a limited space to, in fact, allow for any monetary loosening to fight the shock. They have to tighten to make sure that inflation expectations do not run out of control. And when does that happen? That happens when wage contracts start getting renegotiated for higher and higher wages as a result of rising inflation. And then that becomes a spiraling effect, which is what is not ideal in the sense that then inflation starts shooting up. So policy tightening, I think, would have to be the rule of the game. And the policy action has to come from fiscal side to support the economy, if there's anything.
Thank you. And yet another question. What reforms will IMF be supporting in Ukraine? In the past, the experience of IMF-Ukraine cooperation has been mixed. Do you see more chances for reform success in Ukraine now? I suppose this is after the war.
So now we're getting into, this is exactly what I was trying to avoid, specific questions on policy advice for countries. So I will just say this, I touch on this, that I think immediate focus, at least of my colleagues working on Ukraine, is to meet the immediate needs of the economy, which is that, in fact, there is a very debilitating war going on with the government's ability to collect tax revenues has suffered substantially, but its needs to spend money on supporting the people, emergency support, food support is very high. So they're running, there's potential for very high support for the government, support its budget balance. And that is something that we have been focusing on in our institution. But you're right in the sense that in the long term, once reconstruction begins, it would have to be a substantial effort. We have been two aspects in which the IMF has come into this. One is the rapid financing instrument, which we have provided to Ukraine almost immediately after the war began, which is to support its financial side, its budget. But also we have been instrumental in collecting, or rather setting up a fund that will channel donor money into Ukraine when the time comes for reconstruction. So things are getting ready. But in terms of the question on policy, yes, that was a challenge, and I'm sure that will come up again, but I think the time for that is not right now. And there's another angle to that, which is also what the Ukrainian authorities have referred to, which is building back better when the time comes for building, and building back green. So I think that those are also issues, but I think immediately we are dealing with a crisis that requires firefighting more than thinking long term.
Okay, and I think the last question from me, you talked a lot about the refugee inflow. Well, just in general, how do you estimate the refugee impact, this year, and if these refugees are there to stay for next year or even longer? would it be positive for economic growth overall in the region, or do you think the negative effects, the fiscal effects, etc., would prevail?
Yeah, good question. So this is the question that we've been having a fair amount of debate on. Of course, let's start with the fact that from the economic standpoint, the exit of refugees is a disaster. We are looking at it. The refugees don't want to leave their homes. They leave it because it's unlivable, right? So in terms of thinking about economics is a bit cruel here, and we should always say this first, right? But I think having said that, as I showed earlier, more than half the movement has been to Poland. And Poland, as you know, had a strong history of incorporating, sort of having Ukrainian workers in its economy before the war started. And I think the estimates range between 1 to 1.5 million Ukrainian workers working in Ukraine, because Ukrainian workers working in Poland, because the Polish economy was doing very well. I mean, it had strong demands for labor, low unemployment. That, I think, went through a little transition in the sense that there were some, we were hearing numbers of 80,000, 100,000 Ukrainian workers leaving for Ukraine, and these are mostly men, to engage in the conflict there. But there's also a very overwhelming amount of women and children coming in the form of refugees. Their transition, or women's transition to the labor force, of course, is a challenge. The Polish authorities have made a very strong effort to register these people. That means that they have their national ID cards, which can then be a transition to the labor market. So the sense is that a strong Polish economy, which has strong demands for labor, will be able to absorb a lot of these people, but at the same time, it would have fiscal costs on the Polish economy. And the estimates are still out there, but 1 to 2% of GDP is the range that we have been talking about broadly. But as I said earlier, this is a moving number because today's projection will be outdated a week later. So let's see.
Okay, thank you so much, and thank you for being here and